Hi everyone, I'm John Boughton with NAR Public Affairs. Welcome to our webcast. We're going to jump right into this. I am joined by two tax and real estate experts, Linda DeMarlor, President of Tax Masters Incorporated, and Peter Baker, CPA with Business Planning Group. Thank you both for being here.
Nice to be here.
Thank you, John.
Before we get into the meat of this, I did want to remind everyone, we're going to be talking a lot about tax issues and being an independent contractor and some of the tips that you'll want for how to save a little bit of money at come tax time. But you're going to have some questions of your own, I'm sure, so please send those. You can email them directly to us at realtormagwebcasts@gmail.com. That's realtormag, as in magazine, webcasts, plural, @gmail.com. Should be coming up on your screen. When you have questions, send them our way. We'll get them answered as quickly as we can. But I'm going to jump right into this. Starting with you, Linda. We do hear that independent contractors have some advantages when it comes to tax time. Why don't you give us sort of a broad view of this? Tell us what some of those might be.
Oh, well, some of my favorites are the fact that now they're going to be able to deduct their car, which means not only the expenses for running their car, but even the interest on their car loan, which never was deductible in the past. How about an office in their home, which means they'll be able to deduct part of their insurance and utilities on their home. You can hire your spouse to help you with your work, or your children, or if you don't have a spouse, you can hire somebody else. Basically, anything you spend money on that helps you make more money as a realtor becomes a deduction.
Well, Peter, so talking a little bit more about them, what are some of the things people should be looking for? What do they need to pay attention to? Is there a use test here that they need to be aware of?
There certainly is, and for all these opportunities, what Linda's saying is you need to establish a business purpose in those expenses. And for any of the expenses a realtor incurs that has a business purpose, it would be deductible. But for all that great advantage, there's an obligation, or beyond an obligation, there's a requirement that you have good records. So record keeping is an obligation that goes along with running your own business. So the mindset needs to be, I'm in business for myself, I make commissioned income, and I have expenses that support that earnings process. Those expenses would be deductible. So for the business use of the car that Linda brought up, it's just the portion of your miles that are business purpose. The runs to the grocery store and the movie theater are not deductible. So you're keeping a mileage log as an example. And then the home office that Linda mentioned, it's got to be a dedicated and continuous use of a designated area that's your home office. A shared, the dining room table does not work for making a home office.
So what about, let's say, a laptop? You've got a laptop that you're using at home. It's a business use laptop. Anything people need to know about that? I mean, it's a purchase most people are going to make every couple of years. The laptops get old, they become obsolete, you buy another one.
Yes.
So what do they need to know about that?
Well, now, if it's going to be used all for business, and we can assume it is, because usually everybody has a spare one somewhere in the house, it's going to save them a lot of money. Because most people, if you're single and you make $37,000 of taxable income, or if you're married, you have $75,000 of taxable, all your tax in the federal tax bracket's 25%, plus you're going to pay 15% Social Security tax, and let's say 6 or 8% for your state. Well, that's almost 50% tax rate. So if you spend $1,500 on a computer, after deducting it, it only costs you half, $750. Good money spent, right?
So what about you've got some kids? They want to use your laptop from time to time.
No.
Tell me about that.
They should have their own laptop. Give them your old laptop.
So this is 100% business use.
Yes, sir.
So how? Go ahead.
And
Peter.
in addition to laptops, think of things like a camera. Realtors use cameras all the time, especially when putting on digital displays, rooms, things of that nature. Cameras are now video equipment, so all the digital things they bring to the sales of a house is part of the supporting the sales process. So cameras, smartphones, things of that nature, printers, fax if you have one, all of this equipment is to support the business and would be deductible if dedicated to the business.
I'm glad you mentioned smartphones. I just thought of this while we were sitting here. We turned ours off before the webcast. A lot of people have their iPhone with them. They're likely going to make personal calls. They're going to make business calls. What do they do about that?
It's a prorated amount. Normally our clients, and we do over 2,000 realtors per year, they tell us that it's between 80 and 90% business use on their phone. But if they're just calling home to talk to their children, of course, that would be a personal call.
Okay.
But if they've hired their child to work for them and they're calling to see if the filing has been done, or if they've hired their spouse to help them and they're calling to see if a package has been delivered or a sign been put in place, then it's deductible.
This is a whole lot. So we've talked about mileage, we've talked about equipment, you mentioned prorated use. You got to keep track of this stuff, right?
That's right. The
So-
record keeping is key. Substantiation. And the IRS, if you can't substantiate it, they'll presume it's personal use. So really, and the realtors need to understand, commission is one thing, and I'm not taxed on my gross commission, I'm taxed on the profits of the business. So any of these expenses that you can deduct have the effect of reducing your taxable income, reducing your tax bill, and so saving you 40 cents, 50 cents on the dollar, as Linda has pointed out.
So for a lot of folks who are watching this probably won't be new. If they've been in business 4 or 5 years, they're probably doing a lot of these things. But there might be some people watching who say, "There's a few things I've forgotten, some things I haven't done, or I really haven't been keeping track of some of these things." Anything they can do, Linda?
Oh my goodness, if there's some due deductions that they turn up after listening to us today perhaps, you're always allowed to refile your tax return back 3 years. Of course, if you filed it on time, that's no problem. Sometimes people are a little late, so you have 3 years from when you last filed your return to amend it and claim things. This happens a lot when we get a new client who comes in, who's prepared their own return. We take a peek at it and find things that they've missed. So we file what's called an amended return. We get them back lots of money. You know the most frequently omitted thing that they didn't claim in the
What's that?
past? The office and home expense. Because sometimes it's a deduction of about $3,000. Well, they're all in the 50% bracket, so it's like $1,500 refund right off the top. And they get a state refund too.
Well, we'll probably talk about state taxes a little bit later too, but that actually brings up another point. Most of our folks will have a home office of one kind or another, but let's say they're splitting their time a little bit. Maybe they've got a desk, in their brokerage, but they're doing some work at home as well. Anything they need to think of there?
Well, as long as the space that they use at home is used regularly
Yes.
and exclusively,
Exclusively.
And that's
Peter
the
will
test,
like
right?
that.
Those are the two
Regularly and
terms,
exclusively.
regular and exclusively.
Okay.
Then they can still deduct their home, even if they're paying desk fees at their regular office, or even if they spend a lot of time at their regular office, as long as they have the regular and exclusive. So it can't be the dining room table, as Peter would mention. But now, because they're claiming an office in their home, they can claim much more car expense, because their first trip of the day out the driveway or out of the parking lot is a deductible trip, because they've been to their home office and now they're going to another office location or to see a client. And also their last trip home in the evening is also deductible. So by claiming an office in home, you can hugely increase your deductible business miles.
Commuting miles are not deductible.
Right.
So by making your office at your home, you've eliminated commuting. And very
Which
often
costs you money anyway.
Yes.
exactly.
That's
So
just money out the door.
let those miles, again, business use of cars is prorated based on business miles. So you've just increased your business miles that first trip out of the home. And back to the home office, and often accountants don't find this as advantageous, but the IRS, because so many independent contractors have home offices now, they've recently, in 2013, put in place a safe harbor deduction, which does not require all the substantiation, but gives you $5 per square feet up to 300 square feet. So there's $1,500 if you don't quite have all the records to support. But again, it's a dedicated use of that space. And so there's a safe harbor if you really had to drop back and try to look for some deductions. But very often, if you track actual expenses for your actual business use space, it's a greater deduction.
I'm going to ask you a tricky one. Oh, did you want to jump in?
No, I agree with Peter.
Well, I'm going to
Yeah.
ask a tricky one then. Let's say you do work from home, but for a lot of folks who might be living in a metropolitan area, you have a one-room efficiency. How do you know whether it is a business use or not?
I have a lady who lives in a beautiful efficiency, it's pretty large, at the Watergate. Right
There's
here
some
in
great ones,
Washington.
of course.
And she has an armoire that opens up, and inside the armoire is her computer and her printer and everything. So we have measured, or she has measured for me, the space that she used just for her business. It turns out to be about 5% of the cost. But living at the Watergate is not so cheap. So 5% ends up being a $3,000 deduction for her every year. Plus, remember, she now gets to claim more car expense, because when she leaves the Watergate to go to visit clients on Capitol Hill or out in Frederick, Maryland or wherever, it's all deductible.
So even if you don't have a, go ahead.
So what this taxpayer has done is assured that she has a dedicated use of a space. And even in efficiency where you normally can't accomplish that, again, sharing a dining room, you eat at the dining room table, and if you're using it as your office desk, that's a dual purpose. It needs to be a dedicated space. And so she's accomplished that. That's a great idea.
So even if you don't have a separate office, as long as you have a dedicated space and a tape measure, you can.
That's
you can
right.
Make this work.
And take some photos, please.
Yes, we have a photo, yes.
Good.
Well, that's important to know, and you've both mentioned record keeping. Since we're on the subject of tracking our records, I do want to give a shout out to our friends at Intuit. They're the makers of QuickBooks Self-Employed. You know, this is one of those products that a lot of you may already be familiar with. It's a great way to keep track of your either your business receipts, some of the expenses you're making. And when you come around to tax time, your accountant's going to be glad that you have everything all in one place. They have a mobile app that allows you to keep this stuff. And it's just a great product that when tax time comes around, you're going to be able to save a little bit money at the end. The reason I mention this is because the folks at QuickBooks Self-Employed are actually going to be producing some pretty relevant financial and tax content for Realtor magazine over the next 12 months. So if you're looking for an easy way to keep more of what you can, consider looking at QuickBooks Self-Employed, and do go to our website. I'm going to read this off here. The website is selfemployed.intuit.com/RealtorMag. That should be popping up on your screen. selfemployed.intuit.com/RealtorMag. Again, they're going to be creating some content for us here at Realtor Magazine to sort of help give some of this information and keep people on track with all this information, because there is a lot to know. Speaking of, I should remind everyone that this is a good chance to remind you, if you do have questions, realtormagwebcast@gmail.com, realtormagwebcast@gmail.com. Send your questions. We'll get to them as quick as we can.
John, if I can interject just
please
on
do.
this topic of Intuit and record keeping. Using Intuit as an example, they have interfaces, download access, where you can download your credit card activity and bank activity right into the books and classify it as it occurs.
Now that's helpful.
Extremely helpful. So the independent contractor is losing all excuses to not keep good and current records. It is so easy, and in today's digital age and with the software capabilities of Intuit as an example, these things can happen seamlessly, and there's no excuse for staying on top of your profitability.
And your accountant, we interface with the client online. It's so neat, we can fix their mistakes too, and they don't even have to worry about bringing it all to the office.
And that just makes your life easier.
We
because it's
love
all
it,
in one
yes,
place.
yes, we
Yep.
love them.
And I understand that it syncs with TurboTax as well, which I assume a lot of people use. So good to know. We've talked a lot about the what so far, the what you can expense, how to keep track of things. How about the when? There are some timing implications here. I don't know which one of you wants to jump in first, but when do people need to be thinking of these things? And are there some milestones that they need to put on their calendar?
Every day think about deductions.
Every day.
Every day is deductions, but what I would add, and probably one of the biggest concerns of agents, is when and what do I pay for taxes? And with all these advantages, there's an obligation to pay tax as you go, pay as you go. And the IRS has set up a quarterly system of payment of estimated taxes. And their expectation is whatever your liability for the year, you've paid 1/4 each quarter as you march through the year. And in the real estate industry, of course, that's very challenging because of its seasonal nature. You don't earn it equally for each quarter. And the IRS has ways to accommodate the seasonal nature of any business, but in particular it applies to the real estate business. So what we've done is created, for tax planning and determining profitability and what your tax liability is, it's not something you do in December, or certainly not in April. It's too late to do any planning then. It's really something you should be looking at least quarterly.
Most people who are watching are probably going to have already been through this process a little bit. But let's say you are coming into the business relatively new. So maybe you haven't gotten your first check yet. You're in the midst of your first transaction.
I'm so glad you said business, because now that you've become self-employed, you are a business. Many times I'm teaching a continuing education class for the Real Estate Commission, and I'll say, how many of you are in business? And just a few people will put up their hands. I'll say, no, everybody put your hands up. You are all in business. So yes, so if you're just starting out and you're a rookie, oh, I wish they'd come to my class. But anyway, maybe the first 2 or 3 checks you make, if they're under 10 or 15,000, probably won't be taxed because you have so many expenses. But after that,
Early on,
yes,
right.
it depends. It depends if you're married. Perhaps you have a spouse who's having enough tax taken out. But if you're single, it's going to be up to you, not only to make your quarterly payments on time, but in the proper amount. This is where you need a tax person to help you, somebody who specializes, like Peter, right? Who specializes in helping realtors. It's a whole niche, and you really need someone who's familiar with it.
It is sort of a unique animal. I think everybody, a little bit of help there is appreciated.
And the fortunate thing in that first year, the IRS recognizes in a business it's hard to estimate that first year. And very often that first year expenses may exceed, which would be deductible against other ordinary income. However, there are some safe harbors that in any one year you don't have to pay greater than the previous year's liability. So there's some things they do to help when forecasting is difficult. But there still must be an attempt. And without quarterly payments, there's penalty and interest charges that you can face.
Maryland charges 23% penalty and interest. The federal government only charges 6%. A lot of times the states, D.C., Maryland, Virginia, around here, it's over 20%. So never get behind with your state estimated payments. Now I realize some of your people live in the 7 states that don't have a state income tax. Lucky you folks.
Well, I'm glad you mentioned state taxes. Are the timing requirements different there? How are they supposed to keep up with those as well?
They're basically the same. Virginia has a little bit date that's different for May 1st, but it's usually April 15th, June 15th,
April,
September,
June, yep.
and January 15th, yeah.
Well, so in jumping back a little bit on what we talked about earlier, you can purchase equipment and you can deduct it off of your profits, make a little money back in your pocket. But does it matter when you buy these things?
It depends. If it's a car or something like that that you're going to depreciate over time, it might matter. But as long as you get it in by the end of the year, you're going to be able to claim it. So sometimes when my clients have had a really good year, I'll say, go shopping. Don't you need a new computer? But not that I ever want them to spend money just to have a tax deduction. I'd rather they put the money into their retirement account.
And we're going to get to that in a minute
Yeah.
as well.
Yeah.
On terms of year-end timing, it's also good to note that if you've charged it on your credit card, that counts as having spent the money. So if you're going to buy it, charge it by December 31st. But again, we do not recommend buying things that you don't already need. Don't buy it just for the deduction. But if you need it and you were going to get it anyway in the next month or so, next 2 months, and you've had a good year, then buy it by December 31st.
Now, is that on a yearly basis, or because they're filing quarterly, are there multiple points during the year when they need to beat, if you will, if they're buying some capital purchases?
Oh, if you buy the computer in December, you can deduct it for the whole year. It's a
Fantastic.
section 179. You don't need to know that, but it's thank goodness they allow that.
Well, I promised I would get to some questions, and I am. We just got one in. This one's a little technical, but I'm going to throw it at you anyway and see what you come up with. This is Samantha. She says, if I share a home office with my mother, who is also my business partner, how do I write that off? I'm living at home, but I'm not paying rent, if that's even if that's important. I'll leave either one of you field it if you'd like.
They're in business together. So if they're in business together and they're working together, that's the office for the business. Therefore, it's going to be deductible. However,
both of them?
the mother is the one who's claiming the expenses, probably, because she's the owner of the property.
So the expenses would only be deductible if you incurred them.
Got it.
If a mortgage is deductible only if you're on the mortgage and you're making the interest payments. So there needs to be that connection, and they need to be your expenses. So Samantha, to the extent these are not her out-of-pocket expenses, if you want to look at it that way, probably would not get that deduction.
Well, I feel like we get this individual question from one of our watchers. I think sometimes a story is an easier way to tell this. It's very easy to get sort of into the weeds on this stuff, but maybe some specific examples might be helpful. So Peter, I'll let you go first. Is there a story of someone maybe who hadn't been in the business very long, who came to you with a problem that really sticks out in your mind? Someone who, like, if you could tell everybody this is one thing you really need to do, what would that be? Do you have one of those you could share with us?
Certainly do. Usually it's how do I go about managing my business? What do I need to do? Putting aside choice of entity questions, which get relatively complex.
Okay.
As a sole proprietor, the first thing I tell them to do is get a dedicated credit card for your business and bank account. And don't commingle. You do the best you can to not commingle personal
put the funds
and
together in the
business
same account.
expenses. That's right. And that it's capturing the data and starting to manage. Everyone's about metrics, right? How's my business doing? Well, if you're capturing the data, and it's easy to know your commissions earned, the other side of the equation are your expenses. So that's usually where I put most of the attention, as well as when starting up a business, they are making purchases maybe for the first time. The computer, a camera, a printer, a desk for their home office, a chair, and those things. So it's talking about capturing those costs and getting them up and running with good habits.
So good things to think about if you're relatively new to the business, if you're just getting started. Linda, what if you've been in the business for a while? You've been doing this 10, 15, 20 years. Now they're going to come to tax masters and they're going to say, I've got some questions, here's what I've got. You get someone like that in your office, what tend to be the problems that they may have had up to that point?
A lot of it depends on their marital status. Many times when they've someone who's been a veteran realtor and they're making enough money, if they're married, the husband usually says, my wife is costing me too much tax because now she's making a lot of money. Of course, when you're paying your own income taxes, you also have to pay your own Social Security and everything. So a lot of times we have to do marriage counseling. But then, of course, what we do is we split the income apart. We say, here's the husband's, here's the wife, your share is this, your share is that. But a lot of times we have to show them. Sometimes the wife just gets rid of the husband because she's tired of the complaining, too.
Well, you're not paying taxes if you're not making money, right? So
That's
generally
right. But I have to remind you something. The main reason that realtors stop being realtors is because they get behind on their taxes. So many times we see somebody who's been in business for 10 years, and it may be that they started out, and of course they had a loss maybe the first couple of years, so they thought they didn't have to file. Then they start making money, but then when they make money, that's used to pay up the years when they were in debt. And then all of a sudden the big bucks start rolling in, and now they're afraid because they haven't filed for so many years. We see a lot of those. Yesterday I worked on a client who hadn't filed since 2009, someone who has been in the business for over 20 years. And it's kind of a mess, but it's okay. We figured it out.
Well, if I was going to say, that sounds like kind of a nightmare. I mean, you're supposed to be filing quarterly. You've got all these things you're supposed to do. What if they haven't? What if someone watching this says, gee, I really haven't been doing these things. I haven't been filing. What are their options?
Get a good tax person who's been used to dealing with realtors. A lot of times you can get out of the penalty. Sometimes there's a reason. There was a divorce involved or a death in the family of a parent or something. One time I got out of an $18,000 penalty just by writing a really sad note because my client's dog had died. So, it depends on
Well, the point is things happen, right?
Yes.
Sometimes there are reasons people
And Linda's
Yes.
point is a good one. You always want to file. The last thing you want to do is not file.
This
And
is
you-
not something to avoid.
You have got to file, and at least that starts the statute running. And even if you
Yes.
don't have the money to pay the tax, at least file, determine what that tax is, and there are other alternatives to work out with the government or with states in terms of how taxes are paid on an installment basis or things of that nature.
Yes,
But file the return,
no matter.
no matter what.
Yes.
Well, I'm going to jump back in here. Again, we've got two experts here. They are ready to answer your questions. RealtorMagWebcasts@gmail.com. Ask your own personal question. We'll get it answered as quick as we can. Again, talking about some of the folks who maybe have been in the business a little bit longer. Maybe they're at the point where they're starting to think about their retirement. Talk to me a little bit about this. What do they need to be thinking about right now?
What they need to know is that 16 years ago, Congress did a really good thing. Back in 2001, they passed a law that allows all self-employed people to have what's called a solo 401k. It costs about $50 to set it up. A solo 401k, it's better than an IRA, it's better than this SEP or the profit-sharing plans, because all the money you put into it is 100% protected from lawsuits, creditors, and bankruptcy. The dollars you put in today are fully deductible. You can borrow them out the next day. You don't have to be 59. So let's say you're a 30-year-old realtor. You want to put the money in. You want to borrow it out up to
Say
$50,000.
at 40, you decide you want to buy a second home, or you have an
Yes.
expense, a college
Yes.
payment.
Or something
Boom.
like that. They
Okay.
can borrow it out. Even if you're over 70 and a half, you can still have a solo 401k. But think about it. You all have clients who are self-employed. They may need to access their retirement money to buy a property from you. If they have money in their self-employment plan that's retired, it's qualified, such as a 401k, they can take out $50,000 and buy anything. I mean, you can buy a motorcycle, don't do that, or a boat, don't do that. But if they want to buy real estate, that way my client makes their commission and they get to buy a property. So solo 401k.
Okay.
It's worth adding, tying it back to our earlier conversation, cash management. Manage yourself like a business. So as you're paying quarterly taxes, in essence, what you need to do is each commission is earned and collected, and we know a good portion might be spent in terms of expenses you incurred to earn that commission. You should be setting aside as a benchmark between at least 30 or 40% of that commission earnings. And it's really a dual purpose. You're not only setting aside for your estimated taxes, federal, state, and Social Security, but also your retirement plan. So the most common problem I'll run into, you're scrambling to come up with the tax money. The last thing on your mind is funding your retirement plan, but yet that should be the first thing. Yes. They say pay yourself first. So think of your retirement plan. And the earlier, this is a habit that brand new agents should get into, because the power of compounding. The sooner you start the habit of saving into your retirement plan, the greater it will grow. It has more time to grow.
And that's not money lost. That's your money that, like you said, you can access later if you need it.
At any time. You don't have to be 59 and a half. And you have until October 15th of the following year. Whereas if you put money into your IRA, it has to be in by April 15th. But you have till October to put the money in your solo 401k.
So as we're talking about these family issues, you mentioned this a little bit earlier when we were talking about the problems that people sometimes have, but you know, not everyone who's in the business is also married to someone who's in the real estate business. Maybe they're married to someone who has who isn't an independent contractor. So if they're married filing jointly, what do their taxes look like?
Well, they can be a big mess, but if you have a spouse, you have an ability to hire your spouse to help you. And many times, even though the husband has a regular job, he could be a director of a company or something like that, but maybe they help their lady spouse or male spouse, whatever, to work with their job. So if so, you pay them a small salary. Now you have an employee. You can give them an employee benefit plan. Now you can deduct all of your medical bills as a business expense. Now normally you can't deduct any medical bills because they have to exceed 10% of your income. But if you have an employee, and that employee happens to be your spouse, now the whole family's medical bills become a business deduction.
So, go ahead. I'm going to let you
This
finish.
is the most overlooked tax deduction in the whole tax code for realtors.
Talk a little bit about this. This sounds like something that could be pretty easily misconstrued. How does one hire a spouse? Maybe the spouse has a full-time job elsewhere. So what does that look like if you're actually hiring somebody you're married to?
Okay, well normally it's a lady, she's working, and she has a husband who will go out and he'll pound signs, or he'll deliver things, or if she has to go somewhere at night, perhaps he'll come along to accompany her, or he perhaps helps her on the computer or her marketing. Could be that he goes out and puts envelopes in farms neighborhoods for her, whatever. So she pays him a tiny salary, just like $300 a month, okay? Now that increases his income $300 and decreases hers $300, but they file a joint return, so that doesn't save any money.
It's a wash.
It's a wash, very good. But now, every once in a while, husband comes and says, hey boss, you know, my wife was expensive. Well, who's his wife? His boss. She's had to spend $500 on her new contact lenses, and I had to spend $500 at the dental, and the children had $500 worth of co-pays or something. So now all of these expenses, which formerly were non-deductible personal expenses, become fully deductible, reimbursable expenses to her employee.
Oh, wow.
Now, this law was passed in 1953. It's not a new law. It was passed by Congress to help farmers because they were husbands and wives who worked together, right? The wife would milk the cows,
Sure.
the husband would till the soil. So this law's been around. In my office, we set up more of these plans than anybody in the United States because we've been doing realtors for so many years. But believe me, it's a godsend because otherwise you have non-deductible personal expenses that are gone.
Well, and I understand sorry, go ahead.
And
Peter.
what the IRS requires is they actually, the spouse, whoever, the child or the partner, actually has to do work,
Yes. Of
and the
course.
pay has to be reasonable, commensurate
Yes.
with the work they do. So it's not any sort of sham or anything of that nature. It's actual work done and reasonable pay for that work, and it complies with the law.
According as Linda said, it's a it does, the amount you pay them. That's a wash.
That's
it's,
a wash.
It's about these what would otherwise be personal expenses down the road.
And it's all done through Intuit. If I'm allowed to say
how
that.
about that? Absolutely.
Intuit loves me.
One other we're talking about families and sort of the things that come up, co-pays, medical stuff, healthcare. What do people need to be thinking about from a healthcare perspective?
Well, now, and it's getting stiffer, of course, with the passage of the Affordable Care Act, Obamacare as we like to call it. There's what's termed an individual mandate. Each individual is required to get health insurance for themselves, their family, their dependents. So it's a broad view. And unless you're in a situation where a spouse works and they're covered under an employer's plan that happens to cover the rest of the family, a real estate agent really needs to make sure they've got insurance they've provided for themselves, if not otherwise provided. And if they don't have health insurance, there is a penalty, a surtax. There is a lot of discussion over what you call it. But in essence, and it has been escalating each year since the passage of this law, and in 2016, that surtax, I think, is the penalties $695 or the greater of 2.5% of your income. And in essence, what these penalties do are creating enough of a stick, an incentive, that you're better off getting health insurance. It will probably cost you less than the penalty itself would cost. So it has been an effective measure in this new law that get health insurance or you'll pay the penalty.
And the penalty's not deductible and the health insurance is.
Is. Excellent point. That's right.
So we get another question that just came in as we're talking about business expenses. A lot of people watching will be taking real estate classes. They might be getting some continuing education. They might be paying for certification of some kind. Is that deductible?
Yes, yes. Anything that helps you make more money, anything that makes you smarter, absolutely. Come to one of my classes.
And I'm sure you see a lot of that.
Yes, lots of them.
So again, anything in the course of business, anything that has, what was the use test again? Tell me what was the phrase? It's
ordinary and necessary.
Yes, ordinary and necessary business expenses.
Yeah.
So it means you're not buying a crystal chandelier to hang in your home office.
This is the necessary part, or this is the ordinary
Now
part.
they like green lampshades is what you can deduct. Get the green lampshade, but not a crystal. Oriental rugs, a little hard to justify.
Well, what about the type of car? I mean, some cars get pretty, you see a lot of people out in SUVs, they're taking clients around. Some of them can get pretty expensive. So, what does that look like?
A realtor needs a safe car that makes a good impression on their client. Now, it doesn't have to be a huge Rolls Royce or something like that, but depending on their income, if you're making a lot of income, you're entitled to have a really good car.
And also Congress took care of the luxury cars partly by establishing depreciation limits. So there's limits that you can hit the ceiling no matter how expensive your car may be. There are some limits, and so they've kind of put a cap on super luxury cars. But Linda's right, you need a safe car, often a car where you can have multiple passengers driving them around, especially those clients in the West and Midwest where you're covering a lot of territory, looking at a farm, let's say, things of that nature.
So something in the, a $30,000, $40,000, $50,000 SUV, which is in no way unreasonable, that's
common, very common.
That's absolutely covered.
Yes.
Okay. This is going to happen. You mentioned earlier, the people who forget to pay, and they've got an $18,000 tax bill, as I think what you mentioned. Let's say somebody gets to the end of the year, or they get to the end of the quarter, and they haven't put the money aside. They can't pay. They've got a tax bill that they need to meet, or that they're being billed for. What do?
We can put them on a payment plan. First of all, we want to look at the tax return to make sure it was prepared properly and that every deduction that they were entitled to claim was taken care of. If it wasn't, then we'll file an amended return. But then after that, if there's still an amount due, and this happens, I'm sure Peter's seen it.
Absolutely.
Yeah, we put them on a payment plan. And it's very important to actually file the return, as Peter mentioned, because a lot of times people get afraid they owe a lot of money, so they just put it in the back drawer. Don't do that.
Anything else on that, Peter?
No, I'm just saying the IRS, it's exactly what they even tell you. If you went to irs.gov, the first thing you have to do is file. If you have trouble paying, contact us. We have installment plans we can establish. There is a lot of different options that you can have, that you can set up with the IRS in terms of making those tax payments.
So, I have to imagine if you you see a lot of clients, I'm sure a lot of them come to you at the last minute. They've got a shoebox full of receipts that they just shove your way.
It's fun.
Oh, I'm sure.
It's fun.
We talked about the QuickBooks idea earlier. I mean, are there things that people should be doing along the way? If they're keeping a spreadsheet, if they're keeping should they keep a physical mileage log? I mean, what are some of the tips for just how people get their own? This is an incredible amount of information that they need to keep tabs on, right? So what are some ways to do that? What do you suggest?
Oh, every once in a while I tell people to take a picture of their odometer, and it has the date they took the picture, so that proves at least on that date that was their odometer reading. That's just one way. But there's lots of apps you can get for your iPhone that'll track your driving also.
Okay.
And then you just
Any
click
number,
it.
right? With
Yeah.
iPhones now are a GPS device.
Yes.
So they'll tell you the number of miles driven and they'll keep them as a log. There are a number of other apps that are designed for you to take notes and capture expenses as you've incurred them. There's even some small business credit cards, I understand, that will send you an email each time you've used it with a little form so that you can jot in their notes as to the business purpose. A business meal in particular, the IRS gets very particular, and there's no free lunch, especially when it comes to meals and entertainment, because you only get 50 cents on the dollar. But they want to know who was there, how many people, their names, what was discussed, or in general, what was the business purpose of this meal or entertainment event.
And there is a little loophole too.
Okay.
This all goes back to George M. Cohan, which all of you are too young to know about. But you're allowed to deduct any expense, and you don't even need a receipt, as long as it's less than $75. All you have to do is write down the date, the amount that you spent, and the business reason. A really good example is, let's say the realtor is going off to do an open house. And let's say the house is already vacant, so they're going to stop at the grocery store and perhaps buy something that's going to make the house smell good, maybe bake some cookies.
Sure.
Maybe they're going to buy some Windex to clean the front window. They usually, if it's vacant, they want to take toilet paper with them. I'm a realtor. I've been a realtor for over 35 years, so I know these things. But also they might want to take bottles of water with them. So they stop at the grocery store and they have a whole bunch of things that they purchased. But let's say that $60 worth is what they bought just for the open house. So they write it down, $60, open house, and the date. Now they get there and the yard is a mess, or the garage. So they hire the kid next door to come over, and he mows the lawn or shovels the snow, cleans the garage, tidies it up, and she gives him $50. Well, that's deductible. So at the end of the day, that realtor has spent $110. It's deductible because each of those events was $75 or less, and it's been marked down in her little iPhone or something.
You just mentioned. Go
And
ahead,
what
Peter.
Linda's describing is there's not a receipt for every opportunity.
That's what I was
Paying
getting
the
at.
neighbor $50 to shovel the snow, well,
Cash
he's not going to give you a
transactions.
receipt.
That's right.
And the IRS recognizes these administrative limitations. And so as long as you've jotted a record, you've identified the purpose, it was showing a house, clearing the snow, you're not totally off the hook. You need some record keeping, but you don't have to show a receipt.
So they don't necessarily, you pay the kid next door $30 to mow the lawn. You don't necessarily need to write their name and their address. It's not a full accounting. It's that you paid someone, and here's what the use was for. And if it's under the $75 limit,
Yeah, I would write their name and
You would write their
the
name.
name and
Okay.
the date, and I guess I would already know which open house I was attending that day.
so maybe the address of the
Address.
house.
Yeah.
Okay.
But that's all. But that's a good one because, a lot of times realtors have open houses and they'll stop at Bed Bath & Beyond or something and put some towels in. So it's a good deduction.
Flowers, they love fresh
Yes,
flowers
fresh-
when you're
yes,
showing a house and
something
you
that
stop by
smells good,
the grocery
yes.
store or wherever.
Now, this one's going to be. I suspect the answer is that that people need help on this one. But let's say you have someone who works two jobs. They are a real estate agent part-time, and they are also maybe doing some consulting work, or they're doing something for which they get a 1099, or I'm sorry, for which they get a W-2.
Dual career.
Dual career. What do they
yes.
do?
Well,
Or the things they should be thinking about.
they still are entitled to all the same deductions. Nothing really changes on that. They can still take an office in their home as long as it's regular and exclusive. And they can still take portions of their car, portion of their cell phone, things like that. So they may lose out on the commuting because maybe in the morning when they're driving from home to their regular office,
No
perhaps
choice. They have to go.
They might not. They might not. But however, if they've already been to their home office, now you're driving to a second business location. And if you talk about real estate at your office, now of course you've become it's a business trip. So there's a lot you can do when you're dual career. We have a lot of clients that are dual career, especially when they first start out. They don't want to jump in immediately.
Yeah, that really is not uncommon. It's very regular that you see that. And often being an employee has the advantages that you have some taxes being withheld from your W-2.
Very good.
And very often what you can do is set your exemptions at a lower level there, let's say withhold a little extra amount, such that you aren't caught behind on your 1099 earnings.
Very good.
And even if an interesting point to make, for each separate business, they may be a real estate agent, that goes on its own 1040 Schedule C. Let's say they also have a woodworking shop and they make furniture and sell that. Again, not as an employee, but as an independent contractor. That would go on a separate Schedule C. Each unique business will have its own Schedule C.
Well, and so, is the time frame going to be the same? I mean, I know there's quarterly payments if you're an independent contractor, but you also have this W-2 income that you're going to be paying yearly, I would assume, right?
Yes, yes. Oh, that's fine. That's just so much the better. And that tax is assumed as being taken out all year.
All
so
year.
That's
in the W-2, of course, taxes come out with each paycheck you get. So that's as frequently as you get a paycheck, you're having taxes withheld as an employee. And the IRS presumes that's been there the whole year. So Linda's right. There's an advantage to that W-2 when combining it with a real estate agent who also has commission income.
I think your tip is a good one, though. So they should maybe ask for a little more to be withheld out of the W-2 and then hedging their bets a little bit. If they get a surprise commission in December, transaction closed quicker than they thought, then they're ready to go.
That's right.
Spouses will do this also. It's usually the case where the woman's the realtor, because it's usually many women are realtors, and their husband will have more money taken out at his job if he's a really good husband.
Fair enough. I think some of the mechanics of this get lost too. I mean, people are busy. Thankfully, they took the time to come to our webcast. We appreciate that. But they've got a lot to do, and being a real estate agent takes a lot of time. So we talked about health care. It sounds like you got to get on the phone with Blue Cross Blue Shield or find someone. We talked about retirement. Got to call your financial planner. You got taxes. Got to call your accountant or do it on your own somehow, some way. Is there somewhere that people can go to get their arms around this information, or is there someone that they can be talking to regularly to say, hey, where do I go for all this?
Their accountant should be handling all of this for them.
All of it?
That's the accountant's job. When you go to an accountant, they should interrogate you. Many times we get somebody who comes in for the first time, they'll say, nobody ever interrogated me about all these questions before. But that's how you help the person save money. We tell them what to do. If my clients don't put money into their retirement account after 2 years, I'll fire them. Say, no, you can't go back. Go away. You can't come back. You're not smart enough to be my client. No, they have to do it. They have to do what we say, don't they?
That's right. They don't always do that, but we tell them.
Well, we try.
And Linda's right. Often the accountant is a business consultant, a much broader guide, trying to connect all these dots. Because
different than a tax preparer or somebody, they're doing a whole lot.
It's much broader. Preparation of the taxes is an administrative tax task. That's compliance. But the planning and the looking at the business as a whole is the key part. And that's where you want your tax preparer to be an advisor, because really that's what they're doing. And you want them to help you connect the dots, if you will.
Yes, to make them set up their separate accounts, their checking account, their credit card, and their retirement account, and tell them what car to buy even sometimes.
Couple of tough ones then. You guys might not like this one, but I'm going to ask it anyway. What if the CPA makes a mistake? Something goes in, and this is a question we just got in here. You file something, it wasn't right, and it was actually the CPA's mistake. Real estate agent provided the paperwork, and it didn't get entered correctly.
The CPA should fix it, number one.
Right.
But number two, sometimes it's a breakdown in communications. But sometimes if it's a really bad mistake, don't even have the CPA fix it. Just take all your stuff and go to a new CPA and have it done properly. Because some CPAs are just not as good as we are.
So mistakes do happen, though.
Oh gosh, yes.
Oh, sure.
Yes, we're not perfect. If we were, we'd charge $10,000 for every tax return.
And you find out when you get a letter in the mail saying this isn't quite right, or you missed this payment, that sort of thing.
That's true.
And the IRS now is doing computer matching.
Yes.
So a Form 1099 that comes from your broker is not only given to you, it's also sent to the IRS. The banks do it. Your investment accounts do it. The IRS is expanding the various parties that need to produce documents which support your income or expenses. And so all this computer matching is taking place in the background. So the IRS is generating a lot of letters. And more often than not, it might be an investment account that had dividend income that didn't arrive in the mail. It was never provided from the taxpayer to the tax preparer. And as Linda says, often these things have a quick fix. If you go to your accountant, and he should be able to fix it for you, and it is nerve-wracking getting that letter in the mail, but usually it is not something that's so disastrous. It's often easily fixed and remedied.
Yeah, many times I had, just recently I do a vice president of a very large investment company in Washington, huge investment company, and his wife had a secret bank account that they didn't know about, so he just got a bill from Internal Revenue for $400, and he says, I don't have this account. Why are they making me pay this? Did you forget to put this on the return? So we finally figured out that not only had he never given it to me, but his wife had never told him about it. So he thought I'd made the mistake, but it was really the wife.
This is where the marital counseling piece comes
We
in.
do a lot of marital counseling.
And that's very often where it comes, just something missed in the mail, a small account that has been there forever and you don't pay attention to it. And there's also part of the counseling. It's often helpful to consolidate a variety of these accounts so that the financial aspects are easier to manage. The paper flow is easier, not as much mail, if you will.
Yeah.
You don't need 12 credit cards to support your business, just one.
Well, so, you know, it seems to me that the common mistakes that happen are probably in the taxpayer's favor. They forget to give you the form that on their student loan payments, or they forget to give you the form on some of their health care payments. Probably not on the income side, but you tell me, I mean, what are the common mistakes that you see?
But it's our job to ask them about any student loan payment or anything else. And the best course is to look at their previous year tax return and compare it to what's this year. And if you had it last year, maybe you should have had it this year.
Fair enough.
So there's a whole bunch of things there. But if it was prepared wrong last year, now we're going to do it right this year and go back and amend last year's too.
And maybe there might be a little bit of money coming your way.
Yes, yes. And you know, the refund you get from Internal Revenue is not taxable. The interest on it is taxable, but not the income.
But Linda's right. Often the best guide is looking at the taxpayer's previous return. Or and ideally you have a long history between you and the taxpayer, and you know the documents, the accounts they have, the things they're used to seeing, and I'm always reaching back a year or 2 years to make sure, is anything changed? What's different? What are we missing? And use those to help close the information gaps.
So this is a fairly rare case, but, well, actually it isn't that rare of a case. You've got an agent who maybe works in multiple jurisdictions. They're in D.C., Maryland, and Virginia, which is not at all uncommon around here.
All of our clients, yeah.
I mean, does that create any sort of additional complication that people need to be aware of, or are there changes in the timing that they need to be thinking about, or is it all pretty much one and the same?
Around here it's very similar, because if you live in D.C., even though you sell properties in Maryland or Virginia, you're still going to pay all the tax to D.C. So that's one thing. Now, the states each have their separate laws. For instance, Virginia has a personal property tax on the car, which now becomes business tax deduction because it's a business car. So you need to know about that.
So different in one jurisdiction than another?
Yes, yes.
Right?
We don't have personal property tax in Maryland or in D.C. We have higher taxes, though, so sometimes it evens out. Many times I'll have a client who'll call me up and say, you know, I'm moving back to the D.C. area. Which place should I live? Because which has the lower tax rate? And I'll tell them that Maryland is 8.95 maximum, D.C. is about 8.5. Virginia is only 5.75. But I'll tell them, don't move to Virginia just to save money on the tax if you're going to have to commute all the way out to Rockville, Maryland or something. So, you know, the biggest waste of time during your lifetime is either being unhappily married or commuting. So don't do that. Live where you're closest to your job.
In that topic, this issue of where money is earned falls under the technical name nexus. And states are always hungry for their own tax dollars that they believe are earned in their state. And Linda's right. In D.C., Maryland, and Virginia, there's a reciprocity where they've simplified that, and your earnings are taxed in the state where you're domiciled, as they say, where you live. But that might not be true in some of the other states where they might vigorously fight for earnings that are within their state. So it's a legitimate question, but probably a topic for a whole nother show.
Fair enough. Something that just came in, there's a suggestion, and I don't have all the details here, so if this doesn't ring a bell, let me know, but it says there was a handyman law handyman tax law passed just a few years ago. Did that change the record-keeping requirements?
Yes.
Okay.
Yes. Let's say that you
Glad it
own-
rang a bell. You tell me about this.
Yes, yes. Well, and correct me if I'm wrong, Peter. If you own a rental property and you pay a handyman or somebody $600 or more for doing work on that property, you're supposed to get their name and address and social security number and give them a 1099 form, which would encourage them to then include it on their tax return. So that was
And that's
one.
incumbent upon the property owner.
The
to do
property owner to do so. That's right. You know.
And this is back to our earlier topic. We described the computer matching that the IRS is doing. And they're increasing the scope of small businesses' obligation to produce tax supporting documents like the 1099. So that's what that was about, providing information to the IRS to so they can make sure they're capturing all earned income.
I thought you might add a follow-up on that one. So this is one we just got, and I'm hopeful that there's a happy ending here. They say, I've been in the business for a little while, and I didn't contribute to my retirement early on, but I would like to. Is there any sort of catch-up that I can do? If someone's sort of halfway to the finish line, is there any catch-up that they can do?
Well, if they haven't already filed their 2015 tax return, it's not too late to put money in for 2015 because they have till October 15th.
So that gets you a little further ahead.
That'll get you
The
further.
extended due date.
The extended due date, yeah, if they're on extension. Hopefully they're on extension. And if they're over age 50, you are allowed to put in a little more. Now, if it's a solo 401k, they can put an extra $6,000 per year in. If it's just an IRA, they can only put an extra $1,500 in. So, but anyway, you wouldn't want them to have an IRA or a SEP because they're not qualified. It's not a qualified. You want a solo 401k because it's 100% protected from lawsuits, creditors, and bankruptcy. You can put more money into it. You can borrow it. Just do what I tell you to, because then you'll be fine.
So if you're over, once you get to that 50-year-old mark, then your situation changes a little bit.
You can put in, that's what's called the catch-up. They call it the
Yep.
geezer pleaser. Darn. I'm not admitting to it.
We are starting to come down to the end of the road here. As we get to the finish line, is there, let's break this into two parts. Think about someone who's just coming into the business, a manager. They're walking into your door, and there's one thing you can tell them that they need to be thinking about now that they're starting their real estate business. What's the tip for them?
Oh my goodness! Well, if they're walking into my door, they've already started off on the right foot, or Peter's door, because we're going to set them up. We'll probably set them up with at least Quicken, if not QuickBooks, and we'll give them a list of everything that they can deduct, and we'll tell them to come to my rookie class so they can learn all the deductions. But they've already done the right thing by finding an accountant who knows realtors.
Okay, and you're gonna. That's where we talked about earlier. You're gonna help them with the retirement. You can help them with the health care.
Set it all
help
up
them with their
for
tax.
them. Yes, hire their spouse if they have a spouse, or they can hire their child, somebody.
So people whose pens are furiously going right now, they don't have to remember everything. You get a little bit of help, get some advice.
Well, that's why professionals are there. They're there, they've invested in themselves to be experts in the real estate sales process, residential, commercial, whatever the case may be. But you've got to draw on other professionals who are experts in their fields to help you manage your small business. They're a small business, whether they like it or not.
So how about you? Do you have a tip you want to throw on top of there, Peter, for a first-timer who's walking into the office?
Just an exclamation point. The importance of reaching out to other professionals to help you manage your business. And in particular, if you think of it, your tax bill is the single largest expense that any individual incurs, single largest expense. So it's worth investing the time and energy empowering yourself with the information and the knowledge to manage your taxable bill, the net income subject to taxes.
And ensure you're ready to do those quarterly filings.
And make sure you're withholding enough cash out of each commission check that you have money to pay both taxes and fund your retirement plan.
Now you mentioned that 30 to 40% benchmark
That's
earlier,
right.
maybe, and that sounds like a lot of money.
It is.
But
It is.
some of it's for taxes, and some of that is money you're keeping for yourself for this retirement. Can you give a breakdown? I guess it depends on what your income would be, but
The breakdown is very simple. Most everybody is at least in the 25% federal bracket. To get there, a single person, like I said, needs $37,000. A married couple only needs $75,000 of taxable
and you're in that
income.
25%.
So you're
bracket.
25.
that's-
That's just the federal tax. You have a state return, unless you're in one of the 7 states that doesn't have it. But let's say that's an average of 6%. Okay? Now you have to pay 15.3%, which is your Medicare, Social Security, you can call it self-employment tax, you can call it FICA even, if you're self-employed and not. But in any case, it's 15.3% on your net income. So if you had 15.3 plus 25 plus 6, you're at 46%. Now, that's only on your net income. So by putting away 30 or even 40%, that should cover federal, state, Social Security, Medicare tax, and some money to put into that very important retirement account, which you can borrow out the next day to buy real estate if you want to, or don't buy the motorcycle, don't buy the boat. You can take it out for any reason, but not
And
if
you
you're my
see
client.
that portion that you designate for retirement has the effect of also reducing your taxable income.
Yes, it's
so in
deductible.
essence, there's a play between those numbers where you can reduce your taxable number. Now the Social Security portion, the 15.3%, isn't reduced, and that's driven exactly by your Schedule C, the net taxable income from your 1040C. But many of these other things you can do help reduce the balance of your taxes, and the retirement contribution is one of them.
An example, really brief. If you put $10,000 into your retirement account this year, that sounds like a lot of money, but you're going to get back $2,500 from the federal government.
That you would have paid out anyway.
That you would have paid out, lost anyway.
Better
So
to keep the money.
Now that saves it. And you're in the 6% state probably, so that's another $600 that you're also going to get back. So how much is 25 and 6? It's 31. So it's only costing you $6,900 to have $10,000 growing for your retirement.
And that's money you can draw later if you need it.
And this is why I tell my clients, open up a solo 401k. If you don't, you're stupid.
Well, how about someone who comes into your office, they're a little more seasoned, they've been in the business 20 years, maybe they've been doing everything themselves up to now and doing a fine job of it, but they want a little bit of it.
Never.
You never know.
Never seen it. No. They couldn't possibly do it like we do.
Well,
No.
let's say they
No.
come in and you've got to give them a piece of advice as they're walking in the door. I mean, what are you going to see from someone who's been in the business? What is the likely mistake if you say there's likely to be one?
Oh, missing the office and home, not claiming their car properly, not even claiming the interest on their car loan, not putting money into the proper retirement account. They probably been having a stupid IRA, which only saves them a little bit of money. Oh, I can tell you hundreds of mistakes, but those are the few.
And if these are seasoned, successful agents, very often, if they're coming to you, they may be coming from another tax preparer where there wasn't the style fit, or very often they weren't getting as much hand-holding or advice as they'd like.
Yes.
So really what I often find is they're coming to you for more of that ongoing connection and a greater advisory role and greater involvement in helping them manage their business.
Yeah.
So it sounds like, as we're wrapping up here, if people do want a little bit of extra help, if they are looking to, an accountant who's going to help manage their business a little bit, it's not just the information, there needs to be a personality fit.
That's right. The best way to find a good accountant, ask somebody you work with who they use and who they're helping.
Your broker, another agent,
who
somebody
they
who's
trust.
in the business.
Somebody
Sure.
who's been taking good care of your friend or your associate or even your neighbor. But that's the best way to find a good accountant.
Word of mouth.
Any
That's
red,
right.
Yes.
Word of mouth.
Yes.
any red flags they ought to look out for?
Yes, whoever's advertising and telling you they're going to get you back all this money or they're going to do something like that, stay away from those people. They're spending all their money on advertising. They're not the people you want.
Well, I want to thank you both for being here. Linda, Peter, you guys are fantastic.
Absolutely.
To everyone who joined, thank you as well for joining the webcast. I do want to note, if you came in late or if you had to drop out a little bit early, you'll see this later, we will make this webcast available online so you can review it, or you can go back and just pick out those snippets that you were really curious about. Anything you missed, it'll be up on realtor.org. Thank you again for joining us.